Watch this Bitcoin chart for the next 60 seconds as a tiny test account gains $17 while millions of anxious traders refresh screens hoping to predict the next candle and failing spectacularly each time. That simple move destroys the biggest myth in crypto. You do not need to forecast every swing to profit. You just need a repeatable process that makes your edge appear again and again. Most beginners believe trading success comes from staring at candlesticks all night or chasing every green candle until exhaustion entirely empties their account faster than transaction fees ever could alone. In reality, profitable traders wait for high-probability moments, risk small, and automate exits so they can sleep peacefully while the market either rewards them or politely removes them with minimal damage. Stay with me because the next few minutes will hand you two battle-tested setups, a risk checklist that math itself approves, and a mindset switch that instantly deletes fear of missing out. To prove we are not cherry-picking random hindsight examples, I will trade a live micro position during this video and show every risk parameter before any profit appears on screen. Deal made. You get the blueprint, I take the trade, and together we rewrite what beginner-friendly, profitable crypto trading looks like, explained in clear language, so even your cousin understands the safety nets involved. You clicked this video because endless YouTube rabbit holes left you drowning in jargon, terrified of liquidation memes, and wondering whether profitable trading is reserved for math prodigies with 12 monitors and caffeine-induced insomnia. Take a breath, because within minutes you will see a beginner-friendly framework that translates confusing charts into clear yes or no decisions, backed by real numbers instead of gut feelings or crypto Twitter hype. We start by exposing two psychological traps that quietly sabotage almost every new trader, then replace them with a simple rule set that protects capital even when your favorite coin unexpectedly nosedives overnight. Next, you will master a breakout retest entry and a low-maintenance trend ride, each explained with live chart replays so you understand exactly where to place orders, stops, and reasonable profit targets. After that, we unpack the small position size professional traders use, show why risking only 1% per idea feels boring, yet multiplies survivability, and demonstrate the math with a before and after balance simulation. Finally, you will discover a risk alert checklist and a free training link that expands each concept, giving you confidence to execute your first profitable trade tonight instead of postponing success another painful month. Most newcomers cling to the idea that you must predict price direction with clairvoyant precision, believing one wrong guess obliterates your chance at profit and leaves you doomed to endless Reddit scrolling for insider tips. Reality check. Professional win rates often hover near 50%, yet careful risk-reward ratios convert average accuracy into steady growth. Proving prediction obsession is poison, while disciplined planning is the actual secret sauce. Myth number 2 whispers that more trades equal more gains, nudging beginners into frantic clicking sprees, racking up fees, emotional fatigue, and a messy portfolio incapable of reflecting any coherent strategy by Friday. In truth, every additional trade is another opportunity to make a psychological or technical error. So elite performers limit entries to high-probability setups and spend downtime refining rules instead of hunting dopamine hits. Embed these reversals deep. You do not need prophetic foresight, you need controlled risk. You do not need constant action, you need selective precision. The mindset shift that separates resilient traders from donation machines. Stick around, because next we transform those fresh beliefs into a hands-on breakout retest play you can copy step by step, starting with chart identification and finishing with a protective stop that feels like armor. Our first high-probability move is the breakout retest, a patient technique that converts frantic FOMO spikes into calm entries where the market proves its strength before you risk even a single dollar. Begin by spotting a horizontal line where price has stalled repeatedly, often called resistance when candles cannot close above, or support when they refuse to drop beneath that invisible floor. Patiently watch until a bold candle explodes beyond that line with above-average volume, signaling fresh momentum, but resist the urge to chase because experienced traders know many initial breakouts quickly reverse. Instead, place a limit alert and wait for the price to drift back toward the same level, a retest that filters fake pumps and reveals whether former sellers now defend the line as buyers. Confirmation arrives when that pullback touches the level, prints a strong rejection wick or bullish engulfing candle, and volume returns, suggesting real demand outweighs supply at the freshly minted support zone. Enter a buy order slightly above that confirming candle, Set a stop loss a few percentage points below the line to cap risk, and aim for at least double the distance in potential reward. For example, if Ethereum finally breaks 6,800, retests at 6,800 with a bullish spike, you might enter at 6,820, place the stop at 6,760, and target 6,980 or beyond. This method works because you buy strength at a price already proven significant, risk small thanks to tight placement, and participate only after the crowd shows commitment, stacking probabilities firmly in your favor. Trend following flips the script by letting the market drag your profits upward, rather than forcing you to guess turns, making it perfect for beginners who prefer calm decisions over adrenaline-fueled scalp battles. Many believe successful traders hammer keyboards all day. Reality shows measured participants earn more by sitting on their hands during noise and acting only when price respects a well-established directional staircase. Identify an uptrend whenever price consistently prints higher swing highs and higher swing lows, or simply rides above a gently rising 50-period moving average that acts like a momentum thermometer quickly highlighting bullish temperature changes. When the inevitable pullback arrives, visualize it as a store discount rather than danger. Then watch for a supportive candle rejecting the moving average or trend line, signaling buyers still control the narrative. Place a limit. Buy slightly above that confirmation wick, ensuring you engage only after momentum reappears, and immediately calculate your position size, so losing the trade costs at most 2% of your account. Your stop-loss nests beneath the recent swing low, while your take profit targets either the next resistance cluster or a 1 to 3 risk-reward multiple, whichever offers clearer structure and psychology-friendly goals. Alternatively, trail a stop under each successive higher low, allowing profits to compound during extended rallies while freeing your brain from obsessive chart watching that often breeds destructive micromanagement behaviors. Consider Bitcoin's 2024 bull leg, where price floated above its 50-day average for months. Buying each dip toward that line while selling only after a confirmed close below would outperform frantic intraday hunting. Trend following shines because it compresses decision frequency, reduces fees, and allows you to participate in big directional moves without sweating every candle, aligning perfectly with the stress budget most beginners actually possess. Combine this approach with the breakout retest for tactical entries inside broader trends, and you will already operate more strategically than the vast majority of impulse-driven players dominating public chat rooms. Profitable strategies collapse without rock-solid risk control. So before clicking any buy button, you must define exactly how much you can afford to lose emotionally and financially, treating capital preservation as your primary trading product. Professional traders rarely risk more than 2% of their account on a single idea, because even 5 consecutive losses would barely dent capital, leaving psychological resilience intact for seizing the next valid opportunity. For a $1,000 portfolio, that rule means risking only $10 to $20 per trade, which feels tiny until you remember survival buys compounding time while oversized bets invite catastrophic drawdowns, demanding unrealistic recovery percentages. The simplest safety net is a stop-loss order positioned where your setup becomes invalid, because a small automatic exit beats agonizing manual decisions that usually arrive seconds too late after fear hijacks rational judgment. Locking profits follows the same discipline. Set a take profit or trailing stop at least twice the distance of your risk, ensuring a positive expectancy where a minority of winners can outweigh many controlled losers. Enter positions with limit orders whenever possible because they guarantee price, reduce slippage, and let you plan calmly, unlike impulsive market clicks that leak money through hidden spreads every time volatility spikes without warning. Free exchange or app alerts transform your phone into an assistant, pinging you only when price hits critical levels, preventing endless screen staring and the costly boredom trades that usually follow insomnia-fueled chart binges. Before risking live funds, paper trade or use your exchange's testnet to rehearse entries, exits, and tool placement, building muscle memory that dampens panic when real dollars replace simulated balances. Resist leverage until consistent profitability appears, because borrowed capital magnifies mistakes as viciously as it amplifies wins, and nothing sabotages confidence faster than a liquidation email arriving before your morning coffee finishes brewing. Remember, strategies generate edge, but risk management protects that edge from statistical randomness. Ignore these tools and the market eventually collects every dollar, follow them, and even modest accuracy can grow accounts steadily. Fear and greed move faster than price, And if you let those emotions grab the wheel, every chart pattern and stop loss you learned becomes pointless in seconds. Picture this. Bitcoin prints 3 green candles and Twitter screams, "To the moon." Your heart rate jumps, your finger hovers over the buy button, and suddenly you forget the plan you just wrote. That is classic fear of missing out. The market loves impatient traders because they supply liquidity at the worst possible moments. Most parabolic spikes retrace harder than they rose, leaving FOMO buyers stunned, while disciplined traders calmly wait for the retest we covered earlier. Overtrading is the quieter cousin of FOMO. When nothing exciting happens, you open trades anyway, simply to feel productive, stacking fees and stress until your edge disappears beneath a pile of random positions. Quality beats quantity every single month. Emotional hijack also strikes on the exit side. You move a stop lower because you feel the bounces coming, or you grab profit too early because the small green number looks tasty. Both decisions erode long-term expectancy. Write a short rule sheet and tape it beside your monitor. Maximum trades per day, allowed setups, risk per position, and mandatory break after 2 consecutive losses. If you cannot follow those rules on a demo account, do not trade real money yet. Keep a journal where you document not only numbers but emotions and environment. Patterns emerge quickly. Maybe every rushed trade happens after scrolling social media or trading tired at midnight. Remove the trigger and performance improves automatically. When emotions surge, step away for 15 minutes. The chart will still be there, but the chemical storm in your brain will have settled, letting logic return. Small pauses cost nothing and often save entire accounts. In a moment, you will see the simple math that proves why tiny position sizes protect you when emotions occasionally win. First, lock these mindset fixes in place because strategy plus discipline equals survival. Imagine 2 traders start with $1,000. Alice risks 1%, $10 per trade, and Bob risks 10%, $100, believing bigger bets equal bigger rewards because the win will surely come soon. 5 straight losses hit them during a choppy market week. Alice's balance dips to $950, a bruise, not a catastrophe, while Bob's plummets to $590, forcing him to climb 70% just to break even. Run that string to 10 losses and Alice still holds $904, but Bob is gasping at $349, a devastating 65% drawdown that psychologically paralyzes most people before skill even enters the conversation. Here's the kicker. Both traders use the same strategy. Only position size differed. The math proves edge means nothing when risk is oversized because variance can and will punch everyone eventually. Professional survival hinges on tiny, repeatable risks that keep you emotionally neutral and statistically alive long enough for winning streaks to pay. Adopt Alice's approach and you control destiny. Choose Bob's and the market controls you. So, before you celebrate your next green candle, ask, if this trade loses, will my account and mindset still feel healthy? If the honest answer is no, shrink the position until the numbers and your nerves agree. You started this video overwhelmed by charts and horror stories, and now you own 2 crystal-clear entry setups, a bulletproof 1% risk rule, and a mindset shield that blocks FOMO before it drains your wallet. You watched the math expose how tiny, consistent bets trump hopeful home runs, and you learned to let trends and retests do the heavy lifting while you calmly follow a written plan. Now ask yourself a simple question. Will you trek alone through Reddit rumor fields and fee traps? Or will you follow a proven roadmap with coaching that fills the gaps between theory and real execution? If the second option feels smarter, grab the completely free training linked below. It expands today's concepts with live examples, risk calculators, and a printable checklist you can stick beside your screen before placing your very first trade. Drop a comment, sharing which myth or tip surprised you most. Hit subscribe so you never miss the next belief-breaking guide. And tap like if your confidence level just jumped a notch. Remember, charts do not pay, choices do, and you now possess the process to choose profit over panic. You have the roadmap. Action is next.